Hello everyone. Japan's currency markets were shaken this week. What began as a strong rally for the yen quickly turned into a reversal, triggered not by interest rates but by a bond issuing strategy. Let's break down what happened and why it matters. On Tuesday morning, the Japanese yen surged to a 4-week high, touching 142 per US dollar. This was driven by mounting US fiscal concerns, hawkish commentary from Bank of Japan Governor Ueda, and a sticky service sector inflation at home. A jump in Japan's core CPI added fuel to expectation of a gradual BOJ policy shift. But by afternoon, the yen gave up those gains, weakening sharply to 144.17. The reason? Reports surfaced that Japan's Ministry of Finance is reviewing its debt issuance plans. Specifically, they are considering cuts in ultra-long bond supply, 20-year and 40-year maturities after a poor 20-year bond auction spooked by investors. This move sparked a rally in Japanese government bonds, dragging down yields by nearly 25 basis points. That ripple effect extended globally, compressing yields on US Treasuries and German bonds. But with Japanese yields falling, the yen's appeal as a carry trade target diminished, driving the afternoon seller. After after this, all eyes now turn to the upcoming 40-year bond auction. Its outcome could dictate the next chapter in the Japan's fiscal strategy and the direction of the yen. For now, the message is clear. In Japan, even debt management decisions can move global markets. Thank you.